Joining us now, Barclays Chief U.S. Economist Mark Giannoni. Mark, good to have you here.
Thank you.
I kind of laid it out for why do you expect, I guess in many ways you're in the higher for longer camp. Would that be fair to say?
That's fair to say, yeah. Good morning. Thank you very much for having me. Yeah, absolutely. I think we got great news on the inflation front, no doubt about that. We learned that with the CPI like a couple of weeks ago. We saw a confirmation of that in the PCE number this morning. I think the Fed expected that number to be pretty weak as well on the PCE number. But we cannot take that as a signal of the future trend of inflation. And in particular, I think the Fed is going to be pretty concerned about the chance of inflation remaining as low when it sees that the labor market remains so hot, when it sees that consumption remains really, really strong, and it continuing to power the economy. So I think demand is still really strong. We've seen some slowing over time. We've seen some gradual moderation in the labor market, but I think the labor market imbalances are still there, and Chair Powell has highlighted those upgrade in the outlook projections.
When do you think we'll start seeing the impacts on the consumer? I think, the piece of the puzzle that so many have underestimated is this notion of the lock-in effect. That much of consumer debt, much of household debt is actually tied to rates that don't move. They are fixed. I think 11% of household debt is tied to variable rates. So at what point do you expect to see that hit the consumer, and therefore we'll see that slowdown in consumer spending that we do need to see?
That's right. No, so we saw a very strong first quarter where consumption grew like over 4% quarter on quarter annualized. It slowed down in the second quarter. We expect that to continue to slow down in the third quarter, and then in the fourth quarter actually to flatten out. Part of that, I think, is going to be the resumption of the payment on student loans and both the amortization and the interest payment on student loans that are going to start kicking in the fourth quarter, and probably subtract like a 0.8% to growth in that quarter. So that could actually slow down consumption there, and we expect that to continue overall in the first quarter of next year as well. So we expect a slight downturn taking place in the first.
Are you surprised at the strength of the consumer thus far?
Oh yes, of course. No, we've been surprised consistently with the strength of the labor market, the strength of the consumer. I think there's a very strong feedback loop that's going on between the tight labor market that keeps generating jobs, bringing people into employment, generating income, and with that income fueling consumption. And that consumption then, as households turn towards services, which is pretty labor intensive, maintains the labor market really tight.
What about the spending by the government itself? We've got the CHIPS Act, we've got the Inflation Reduction Act, we've got the infrastructure bill. Yep. A lot of money going into various projects around the country. Does that have an impact?
Oh, it does, certainly. So it's not only a lot of money from the government, but also provides incentive to the private sector, right? And we saw a lot of investment in equipment, infrastructure in particular, in the second quarter as well. And construction spending for infrastructure projects is really, really booming at this point.
But basically you're saying, I'm sorry to go back to this, but it really was interesting the way you're talking about student loan. That's going to slow down the consumer. That's the biggest impact. So there's really no, in your view, transmission mechanism from the Fed raising rates to the consumer immediately. It sounds like it's all going to come from the problem that consumers will have in terms of paying back their student loans.
So I do think that the interest rate effect will have will have an impact on consumption over time. So as rates go up, the incentive to save are also a little higher, and as people also deplete their accumulated savings that they got during the post-pandemic period, they are going to feel a little less wealthy over time, and are going to slow down their pace of consumption. So I think this is all part of the traditional transmission mechanism of monetary policy, where over time, as rates remain elevated, it starts biting the consumer more and more over time.